Silver is at $9,000 per ounce. That number just leaked and Wall Street is pretending it doesn't exist. But the math behind it is absolutely undeniable. I mean, you've probably heard wild silver price predictions before, but this one's different. This time it's coming from treasury data and historical ratios that can't be ignored. But where is this number actually coming from? And why is nobody in the mainstream talking about it? Well, let me explain. Disclaimer, let's start with what just happened to silver prices, because this is where the story gets absolutely wild. Silver just crossed $120 per ounce for the first time in human history. Think about that for a second. We've broken through every resistance level, every historical ceiling, and we're now in completely uncharted territory. But here's what makes this move absolutely extraordinary. Silver is up 68% this month. Not this year, not this quarter. This month. In just 29 days, silver has delivered returns that make the entire equity market look like it's standing still. To put this in perspective, silver just quadrupled the S&P 500's entire 2025 return in less than a month. The stock market bulls who spent all year bragging about their gains just watched silver investors make 4 times that return in 4 weeks. Drop your entry price in the comments. I want to see how many of you caught this move early. This isn't a normal market move. This is a monetary event disguised as a commodity rally. Now, here's where things get statistically insane, and this is what has the quant traders and risk managers on Wall Street absolutely panicking. Silver just recorded what's called a 6 sigma event. Let me break this down because understanding this is crucial to grasping the magnitude of what we are witnessing. In finance, we measure price moves using standard deviations, which we call sigma. A 1 sigma move is mundane, happens all the time. A 2 sigma move is common. A 3 sigma move becomes rare. A 4 sigma move is exceptional. A 5 sigma move is extremely rare. But a 6 sigma move? That's supposed to occur once in 500 million observations. These are the kinds of events that break risk models and force regulators to hold emergency meetings. And silver didn't just hit 6 sigma over a period of weeks. It hit 5 sigma on the rally, then reached 6 sigma on the drop in a single session. 1 trading day. That's not price discovery, that's a system under extreme stress. To understand how rare this actually is, let's look at the other 6 sigma events we've seen in modern financial history. The October 1987 crash, where the market dropped 22% in a single session. The March 2020 COVID crash, when global markets went into freefall. The Swiss francs surge in January 2015, when the Swiss National Bank broke its peg to the euro. And WTI oil going negative in April 2020, when traders were literally paying people to take oil off their hands. These aren't normal market corrections. These are structural breaks in the financial system. And here's what should terrify anyone who is holding physical silver. We just had 3 6 sigma events in 1 week. Silver did its impossible move, but it wasn't alone. Japanese 30-year bonds recorded a 6 sigma session last Tuesday. In gold, it's up 23% in less than a month, approaching its own 6 sigma territory. 3 assets, 3 6 sigma events, 1 week. This has never happened before in recorded financial history. Now, here's what Wall Street doesn't want you to understand about 6 sigma events. They're almost never triggered by a simple headline or a macro data point. These moves come from something much deeper and more dangerous. They come from the market's internal structure breaking down. We're talking about leverage unwinding, positions that are too concentrated, margin calls cascading through the system, collateral problems, and forced buying or selling by institutions that have no choice. When you see a 6 sigma move, you're not seeing investors calmly changing their minds about valuations. You're seeing the mechanics of the system itself seizing up. And when we see 3 of these events in different asset classes within days of each other, we're not looking at isolated incidents. We're looking at a monetary regime that's cracking under pressure. Think about what these 3 assets represent. Japanese bonds sit at the heart of the global financial system, the foundation of the carry trade that's financed trillions in leveraged positions around the world. Long-term sovereign bond rates tell us something about the credibility of states and their ability to honor future debts without resorting to inflation. When that market has a 6 sigma day, it's signaling that something fundamental has broken in the confidence around government promises. And then, just days later, we see gold and silver exploding with equal statistical impossibility. Precious metals tell us something about the credibility of the currency itself, about whether people believe paper money will hold its purchasing power. When sovereign bonds and precious metals both become unstable at the same time, we're not looking at a market correction. We're looking at a challenge to the entire monetary framework. These events don't happen in isolation. They're connected. The credibility of currencies and sovereign debt is being questioned simultaneously. And when these frameworks start to crack, the adjustments are absolutely brutal. Now let's talk about what's happening in the physical silver market, because this is where theory meets reality, and reality is winning in spectacular fashion. We're getting reports from major refiners and mints that should send chills down the spine of anyone holding a short position in silver. Perth Mint, one of the world's largest and most respected precious metals refiners, is not accepting any new silver orders. Read that again. Not accepting new orders. Metalor, another major Swiss refiner, same story. Argor Heraeus and Nadir, two more major players in the refining space, are reporting severe backlogs with delivery timelines pushed out to April and May. These aren't small boutique operations. These are the institutions that supply the physical metal to the entire global market, and they're tapping out. But here's where it gets even more interesting for silver investors. Wholesale premiums, the markup that dealers pay above spot price to secure physical metal, have spiked 100 to 200%. That's not a typo. Premiums have doubled or tripled in a matter of weeks. What this tells us is that there's a massive disconnect between the paper price of silver trading on exchanges and the actual cost of securing real physical metal that you can hold in your hand. Dealers are scrambling, actively sourcing whatever silver remains available in the market, and they're having to pay unprecedented premiums to get it. Retail premiums are being adjusted upward to match these new wholesale realities, which means if you're trying to buy physical silver right now, you're paying significantly more over spot than you would have just a month ago. This is the physical market screaming that there isn't enough metal to meet demand, and this physical shortage is showing up in the data in ways that are impossible to ignore. COMEX silver inventories, the registered and eligible silver sitting in exchange warehouses that is supposed to be available for delivery against futures contracts, are falling fast. We've seen a drop of 34 million ounces from the highs, bringing total inventories down to 415 million ounces. That's the lowest level we've seen since March 2025. But the really alarming number is this. Since September's peak, the stockpile has dropped 117 million ounces. That's a 22% decline in just a few months. This isn't normal seasonal variation. This is a massive drawdown driven by physical demand overwhelming available supply. Now, here's why falling COMEX inventories matter so much to silver investors. When inventories drop, it indicates strong physical demand, but more importantly, it means short sellers are struggling to find actual metal to deliver against their futures contracts. Think about how the futures market works. Traders can sell silver futures without actually owning any silver, betting that the price will go down so they can buy it back cheaper later. But if a contract gets called for delivery, they need to produce real physical silver. And right now, there isn't enough physical silver available. When these short traders can't find metal to buy, they have to accept whatever price sellers are demanding. This pushes prices higher, which then forces even more short traders to cover their positions to avoid catastrophic losses, which pushes prices higher still, which creates more forced buying. It's a feedback loop. We're watching a classic short squeeze play out in real time, and it's happening in a commodity that's absolutely essential to modern technology and infrastructure. This is where the story gets really interesting for long-term silver holders, because we need to talk about the math that Wall Street desperately doesn't want you to calculate. There's been analysis circulating that suggests a gold revaluation to $73,500 per ounce is plausible based on U.S. Treasury statements and the relationship between gold reserves and monetary base. Now, whether that exact number plays out or not, the thought exercise that follows is what matters for silver investors. If gold were to be revalued to that level, the implications for silver become absolutely explosive because of something called the gold to silver ratio. The gold to silver ratio measures how many ounces of silver it takes to buy 1 ounce of gold. Right now, that ratio sits somewhere between 45 to 1 and 50 to 1. That means it takes about 45 to 50 ounces of silver to equal the value of 1 ounce of gold. But here's the thing that most investors don't know. Historically, that ratio has been much, much tighter. Throughout most of human history, the natural ratio has been around 8 to 1. That's not some arbitrary number. It reflects the actual relative abundance of these metals in the earth, its crust, and the historical monetary relationship between gold and silver. For thousands of years, civilizations understood silver as monetary metal in its own right, not just as gold's cheap cousin. So let's do the math that makes silver investors so incredibly bullish right now. If gold revalues to $73,500 per ounce, and if the gold to silver ratio compresses back toward its historical norm of 8 to 1, then simple division gives us a silver price target. And that number divided by 8 equals over $9,000 per ounce of silver. Now, before the skeptics dismiss this as impossible hype, understand what we're actually talking about. This isn't speculation. This is ratio compression. Comment below, do you think we actually hit $9,000, or does something break first? This is what happens when decades of artificial price suppression through paper derivatives and leveraged futures markets finally breaks down and prices have to reconcile with physical reality. And here's why that ratio compression is not just possible, but likely. Silver's role in the modern economy makes it far more critical than most investors realize. Silver is essential to energy infrastructure, particularly solar panels where it's irreplaceable for efficiency. It's critical to defense systems and military applications. It's fundamental to artificial intelligence hardware, data centers, and the entire electronic supply chain. Every smartphone, every electric vehicle, every 5G tower requires silver. And yet silver trades at prices that reflect decades of paper market distortion, where the paper promises of silver have vastly outnumbered the actual physical metal available. When gold reprices in response to monetary instability, ratios don't stay broken forever. Physics and chemistry don't care about derivatives contracts. If you need silver to build solar panels or semiconductors, you need actual metal, not a paper promise. And that's when industrial demand collides with investment demand, collides with short covering, and prices have to adjust to reality. Silver doesn't need a miracle for this math to matter. It just needs the paper markets to break and the physical markets to set the price. And based on what we're seeing with refinery constraints, COMEX inventory drawdowns, and unprecedented premiums, that's exactly what's starting to happen. The $9,000 silver number isn't pulled from thin air. It's what happens when you combine a potential gold revaluation with a return to historical ratio norms. And those norms exist for fundamental physical and economic reasons. Now let's zoom out and look at the bigger picture, because what's happening in silver doesn't exist in a vacuum. Gold is up 23% in less than a month. That's not normal. That's approaching its own Six Sigma territory. When you see gold and silver both breaking out with statistical impossibility at the same time that Japanese bonds are recording Six Sigma sessions, you have to ask yourself what connects these events. And the answer is simple but profound. We're witnessing a monetary regime shift in real time. These aren't isolated market moves that happen to be coinciding by chance. These are connected symptoms of a financial system under extreme stress. The Japanese bond market sits at the center of global dollar funding and carry trades. When that market becomes unstable, leverage across the entire system has to contract. And when leverage unwinds, two things happen simultaneously. Forced selling in certain assets as traders have to meet margin calls, and forced buying of protection in others as institutions scramble for safety. Historically, precious metals are almost always among the primary beneficiaries of this flight to safety, because they're the only assets that aren't simultaneously someone else's liability. When confidence in sovereign debt wavers, when questions arise about whether governments can honor future obligations without massive inflation, when currencies themselves become suspect, gold and silver are where capital flows because they can't be printed, they can't default, and they've held value for thousands of years. What we're seeing right now is markets explicitly telling us that the monetary framework we've operated under for decades is cracking. When frameworks crack, when regime shifts occur, adjustments don't happen gradually. They're brutal. They're violent. What percentage of your stack is physical versus paper? Let me know in the comments. They happen in Six Sigma moves that break every model and exceed every forecast. That's exactly what we're living through right now. The statistical impossibility of 3 Six Sigma events in 1 week isn't a coincidence. It's the sound of a system breaking. But what is your opinion on this? Comment down below. If you are curious to find more, then make sure to click on one of the videos you see on the screen. And with that, we come to the end of this video. If you enjoyed the video, then turn on the notifications bell on this channel. Missing an important silver update might make you lose money, so don't risk it. Also, please share this video with as many people as possible. Let's get this news out there.